The mid caps have been leading the way. Hi everyone, this is the 3rd of June 2018. This week we've seen the mid caps for a fourth week consecutively close much lower. Some indices did give a minor higher close for the previous week, but more or less these indices have been down and they only pulled back to touch the 20 DMA and then give up all over again. They're also below their weekly averages. So significantly down compared to what the Nifty or Bank Nifty have been doing. The key frontline indices have actually managed to hold on longer than I would think, given the size of the divergence that we have seen. I don't think I've seen this size of divergence ever in the past. I've tried to go and look back. Most major tops in markets have seen mid caps had either lead, lag, and top out earlier or later. In fact, up to I think 2010, mostly they would end up outperforming for a longer period than the index itself by either a couple of days or weeks, depending on the significance of the top that was occurring. For the first time in 2013, I actually got a reverse lead lag, which means the mid-cap indices peaked in the first week of Jan 2013, and the Nifty continued to hold on to its gains till the end of the month. So that was the first time we saw a reverse divergence, and after that, I think continuously we've been seeing instances of reverse divergences, and the last 9 months were very, very particular because we've seen repeated extremes in readings in data, in sentiment, in the behavior of these two segments to each other. And even after the Jan high, where I think it looked like probably you'd reach the extremist because a lot of data points in terms of put call ratios and all were the highest in many, many years. And simultaneously, along with that, the mid caps did do that 2-3 week lead lag, which means they peaked around the 8th to 10th of Jan, and the Nifty continued to hold on to the end of the month, and then both of them gave up together. So it's very, very rare to see one segment continue to fall like we've seen in May for an entire month, because the mid caps this month peaked around the 4th of May, and the Nifty still not catching up. So one of the two is going to happen. You can keep thinking one way or the other, but the fact of the matter is that in terms of stocks, the losses have been significant or magnificent in terms of what has the downside has been for most of them since Jan itself, or even earlier, depending on what you're looking at. So, what do I think is likely here the case? I don't think the catch up is going to be of the mid caps to the large caps. Of course, anything can happen, but the way they've broken their weekly charts, typically I would expect them to continue that trend lower, and eventually the Nifty would end up catching up with that segment. The question is only a matter of when. And if it's an entire month that it takes, then of course there's some repeat value in saying that 2013 you waited till the end of the month, which means post expiration the Nifty started its move down. The same happened in Jan 2018. I think mid caps peaked in the beginning or second half of second week of the month, and then the Nifty caught up only after the Jan expiration, and you had of course the budget simultaneously occurring after that. And so why not the same in May 2018, where we've had mid caps continue to fall for most of this month, and then next month I guess the Nifty should do the catch up job. So we should be on the edge of that. And what else has been happening is that you have data which has started to turn the other way, although it's not really showing up in terms of earnings numbers. So what do I mean by data? Typically, when I'm discussing my economic cycles, I always speak about that growth's not going to happen, and you really didn't see that for a long while. But you do see things like GDP numbers that come out from the government actually ticking up a bit over the last 6 months. Now, you might say some of it is got to do with base effects of last year. You also see something on the same lines where credit growth has actually picked up from its lowest level, which I think it had reached near or around demonetization, dropping to almost 4 to 5%, and then from there it has continued to pick up 6, 8, 10. Now this month we reported around 12% credit growth. The IP numbers, of course, have continued to remain erratic. They picked up and now have been dropping off a bit. But so some of these numbers turning up can actually make up for a good argument of the economic turnaround actually happening. But on the other hand, you really don't see it in earnings growth, and so that's really the big question. I think this quarter's numbers, as per one report, was showing that you're looking at a minus 16% growth, and even if you exclude financials, you'd still be at minus 2%, which means you could actually be looking at negative growth for the Nifty pack. versus in between that you had a couple of positive quarters and then you had negative quarters more than a year back, and people thought that would be an aberration, and most forecasts continued to be from brokerage houses for a bounce back to double digit growth, and so they continue to do that, pulling down their future numbers every time numbers don't match, but at the same time continue to project that next year is going to be the year where you get that growth. Well, it's not really happened yet. And now, of course, in another month, we'll start looking at the first quarter of this year's numbers once again. So this process simply seems to be a repeat and rinse. But the idea to take off is that if you have underlying economic data that is picking up, and if you're really not seeing it in earnings growth, then the question is, why is that really happening? And it could do with two things. It's mostly got to do with costs moving up, because definitely revenue numbers have pushed up a bit, and usually if GDP is growing, then revenue is growing, because it's a function of how much you're producing and the inflation rate. And inflation, even though low, is always positive, and therefore you always have a macro level revenue growth happening. The question becomes, why is earnings not growing? And that could mostly come down to costs. And the big feature of the last 2 years has been rising costs because of inflationary expectations, something that I've spoken about a lot. And there's already an expectation getting built up that you might see a stagflationary environment, at least in the US markets. And in our own case, if you get a tick up in inflation on the backdrop of globally inflationary trend, then and you already have some of that, so you have costs moving up. Material costs, of course, in terms of commodity prices, and oil is in specific, have already moved up. But the other reason could be the bigger component being interest rates. So as people are borrowing more, they also have a higher interest component. The reason as to why they are having to borrow more, which is the credit growth, may not be apparent at this point of time. You can say that growth is coming essentially on the back of a pickup in actual underlying growth of the economy, and therefore earnings growth, credit growth is really a reflection of real growth beginning to take off. So that's one argument you can make. But when I look at it from a very different perspective, which is put it in context of the quantitized cycle, then we've been at the fag end of the credit cycle, which is like a 60, 70 or 80 year kind of cycle, where our debt to GDP ratios are as high as they would have been for any other economy at the end of such a cycle in the past. No comparisons being made with where rest of the world is today because of modern financial innovation. But in that sense, since we've already reached those levels, our economy is not able to grow unless you get some kind of stimulant, either in the form of OMOs, some stimulus by spending by the government, creation of new projects, or raising of salaries of the public sector, something that has been done many times in the last several years. Since we've entered the late stages of the spring, the autumn bull market, and entering into the winter period. In terms of economic data, I already say that we are in the winter period because credit GDP is high, and that has already started to reflect in defaults and rising NPAs, which are all problems that you usually see in the winter cycle. So in terms of economy, you're already in the winter cycle, and what happens then is most of the new borrowing is essentially to support old borrowings or to meet costs. And when that happens, you're really not witnessing earnings growth. So most of the borrowing is really not going towards growth, but going towards supporting an existing economy. And from that leads me to think that if you're really, if all this thesis is true, then primarily what you're looking for is a broader based slowing down at the economic level. And the problems that you're really seeing in NPAs, which are mostly being pushed only to the private sector banks and a couple of public sector banks, and only a couple of private sector banks like probably Axis and ICICI that have been reporting it. It cannot only be the case, because eventually most corporates are going to be borrowing more, or most of the public, which is retail loans, are going to go up, and a lot of that is held by the private sector banks, the NBFCs that have been lending at the farm level or non-urban level, and NPAs in many of these areas would also eventually pick up. So it would become a much more broad-based and economic issue than it already is or getting recognized at this stage. Now, while I actually say this, some of it might sound like, oh yeah, that part is not possible. But that's similar to the thinking that you would have had around 4 or 5 years ago when I started writing about the economic winter, that we have a problem and corporate debt ratios are moving up, something I was seeing way back in 2014. That has reflected in INPAs only after the IRBI actually pushed the banks to start reporting it, so they were not willing to report it as well. So the fact is that the existence of that cycle and the knowledge of it allows you to think that this is what you expect would happen during this stage. And when it starts playing out, it means you're probably right about the cycle itself, versus really waiting for numbers and data to show up and to tell you, oh yeah, this is why it's really happening. So the sense from a cycle perspective is this is what's going to happen. Your NPAs cannot be restricted only to the public sector. They will eventually show up in NBFCs and the private sector that have been high growth areas. And some of them have also become extremely overvalued. So there was an interesting report, I sent it out on the mailing list, because most of such studies have been done around the US, that if you buy on high valuations, your long-term returns cannot really match the risk or even the the risk-free rate of return. And he did a similar kind of analysis as to where we are today, and came to the conclusion that even if we did manage growth to come around, if you're buying stocks at the current valuations, your long-term growth projections would really not be met, or at the most you'd probably achieve a fixed deposit kind of or risk-free rate of return, but not be able to essentially beat that. And so that defies the whole objective of long-term equities as a hedge against inflation. So the angle that a lot of people take is, yeah, but then we'll just focus on the few growth areas which have been around for the last several years based on consumption, and consumption coming from essentially government spending or raising salaries of the public sector, or giving MSPs, which is raising prices for agri products. And the way these things are going is that it's almost becoming addictive. If you go by the recent news that farmers have started to protest aggressively against prices not being raised recently. So essentially they want to keep raising agro prices because there's no other way they can actually achieve higher income growth that they've become addicted to, because the government has essentially been handing those out, and now it will become more of a regular feature, which means that most governments that will come to power will want to actually offer these kind of SOPs to the segment at large to win elections. So as we head into the election season, which is next year, if you've really seen the amount of pressure and effort that the key parties have had to put in to win each and every seat at a state level, that it is making national news, something that I've really never seen before, because state elections were often the most ignored events, both from a general news perspective and also from the stock market perspective. But now they make headline news. So and you also see the effort where the PM is essentially to move out, and not only that, even in the opposition parties, the biggest frontline leaders have to go and fight it out, because it's becoming a tough fight. And looking by the numbers, as we are heading into the next election, which is just more than a year away, or well, almost just around a year away, then you're likely to see increasing pressure for, in fact, anyone's sense would be that you're likely to see more populist measures occur during this period, given the size of this fight, and that some of the recent elections actually didn't go in favor of the parties that are at the helm. So is that typically good? Not at all, because it takes the attention away from looking at what the economic needs are, and the limited spending that you have. If it goes towards more populism and more promises of the same ahead, then it would already hurt what is an extended credit-based economic environment that we have. And so far, what the government has done in the past is it's allowed credit to build up on the corporate side versus the government side. So if you see those charts in my economic winter reports, which are there on the website, then you'd see I've plotted the charts, and it very clearly shows that post 2000 the government debt to GDP ratio actually started to come off, whereas the corporate side debt to GDP ratio shot off to the upside after 2010 onwards. And so most of the growth came because of new credit being taken by the private sector rather than the public sector, because they were not supporting it. But eventually now, if the public sector is going to be spending more to meet these demands, then the government debt to GDP ratios will also be put under pressure to move up, though we continue to say that we are not going to allow that to happen. But in some way it will happen either through inflation or through credit related issues which we are already facing in the public sector spreading to the broader economy, which means as in when we face these NPA risks either in the public sector or the private sector banks, the government so far has not been directly bailing out, but as in when you're supporting that sector with fresh funds, that additional funding is moving the credit from the private side to the public side, and so you'll find a time where the ratios will completely shift, where most of the debt will have to be taken on by the government, and that shifting will keep credit ratios high unless you actually either inflate the broader debt away or you completely bail it out or write it off. So one of these things has to happen, and and everything that I'm talking about essentially is related to an economic winter. Based on the quantitative cycle. So the cycle essentially says these are the issues that you'll have to deal with and address during a winter. And since these are the issues we face, I guess the forecast for an economic winter is not wrong. And how does it typically end? It ends because of a credit crisis, which means it leads to credit risk getting priced into the market, and that means higher interest rates at some point of time, much more than where we are. So the interest rate cycle did drop most through 2010 and was actually pushed down further by demonetization even when global interest rates had started to tick up, and that provided us with that initial stimulus to keep the market's momentum on low rates. But even as growth is picking up and credit is picking up, now that we are in an environment where global interest rates are still moving higher and we are catching up with them, if you just look at the last 2 months of data, foreign investors have started to pull out of Indian debt markets on fears that rates would eventually move up, something that's already happening in various emerging markets. And so the projection should be to look for high interest rates irrespective of some short-term pullback in the Indian 10-year G-Sec yields. My sense is that these yields will continue to move higher. My long-term projection as per my posts have been that you'll eventually go back to 9% at some point of time. I've not pointed to too much above that into double digits, but a spike is possible, but I'm really not sure whether it will be even bigger than that when things come around, given that we are actually facing the risk of a global credit crisis all over again if interest rates around the world continue to rise. But the key factors for global rates to rise have not gone away, which means at least over the next couple of months, it is apparent that based on research that I am reading, that you continue to get stagflationary trends, which means rising inflation data coming in that could actually keep pressure for interest rates to go up. But all of that said, now that everything that I'm talking about is pushing me to now focus on what are the global macro trends. And we are getting a lot of divergences in global macro trends. For example, the dollar, my primary case was that the dollar peaked at the start of 2017 and would be heading into a multi-year bear market. But as it headed towards 88, it's held that support. And while I'm maintaining my longer bearish case for the dollar, I'm talking about the dollar index, it has stopped near 95, which is an important resistance, and if it does get above that, then we would have to look for larger retracements. Also, in doing so, at 88, it has held the rising trend line from the 2008 bottom where the dollar bull run actually started. So you've had this 7-9 year bull run in the dollar, and it's actually not broken that trend line. And so you can actually make a case which many hedge funds are making already, and they've been making the case that you would have this last one spike up in the US dollar to a new high before it completes the cycle, and my sense was that 9 years done was sufficient. So that's an open debate. I don't think it's concluded. It's possible they turn out to be right, but something that I spoke in a lot of my podcasts and videos last year could also be possible, and it's already somewhat apparent that the dollar index, which is only made up of components of the key developing market currencies, which is the euro or yen, they may actually see the DXY weaken. But on the other hand, you'll see a lot more weakness in emerging market and other currencies compared to the dollar. So you'll actually see dollar strength relative to other currencies. And the reason for these trends might be as to where the dollar has flowed. So if you go to the bull market in the last bull market in the dollar from bear market in the dollar from 2001 to 2008, essentially a lot of money moved out from the US to emerging markets, and commodity prices moved up. And so when those trends reversed, the dollar essentially started to go up as money flowed back from EMs to the US. Now, what has happened in the subsequent period is money is actually moved out of a lot of crisis areas into the US assets, whether it's from China or from Europe, and which is why my sense has been that the next time the dollar moves lower, you actually have a reverse money flow occurring out of US assets into some of these other places. But at the same time, if it causes US asset prices to go down because of the falling dollar, which means we are falling equities and bonds, something we've started to see for a while. Then it could also mean simultaneously that other currency pairs, especially those emerging markets, actually fall against the dollar even though the dollar index is going down. So that's one possibility that I highlighted. Given that in the short term, I still see at least the yen, that's one of the currencies, further weakening from here in the short term. I don't know whether it's a long-term move, but that could mean that the dollar index gets support from the yen itself. I'm not able to clearly say that for the euro too. Very, very short term, it's possible that the dollar dips a bit, but then tries to attempt to move up again because of many of these divergent trends. And these divergent trends are therefore also showing up in how various markets have behaved for the last 6 months. So you can see a lot of emerging markets, especially Asian markets, have actually fallen very, very sharply. But on the other hand, while maybe a KLSE, or a Philippines may be closer to their 6-month lows, the Japanese index, which is the Nikkei, has actually bounced back post-March, reflecting the weakness in the yen. So there have been different markets that have worked differently. The weakness in a lot of Asia and emerging markets has actually not spilled over to India, even though we've seen a much weaker currency. So somehow our equity markets did not respond to the same weakening trends in currency and bond markets that many other Asian peers did. But if those trends actually continue, I think they could become worry fronts. But on the other hand, we've continued to try and mirror what the European and maybe the Japanese or US, which is basically some of the developing markets, have done in terms of their up and down moves. But my sense is, I mean, as always, there have been periods before where eventually we've come under pressure because of what has been going on in the EMs, rather than reflecting what is going on in the DMs. And so I think that would probably happen again if the pressure on the INR continues. Now, INR has actually pulled back a bit. The USDINR is back to its 40-day average support, and somewhere around, I think, 65.80 is the lower Bollinger Band. And if it takes support there, then essentially we can actually start talking about the next wave up starting. And if that's true, then you'd probably get past the 69 mark this time around, or at least test it. So weakness in the INR would again put similar pressure on the Indian bond market, driving up yields. And so on that front, you would expect interest rates to actually move up. We have the policy meet just coming up this month, and expectations are increasingly towards a rate hike at least being done now to keep inflationary expectations down, or to actually map what's happening in other parts of the world, and also to stay in tune with the global bond market, so that our currency does not overreact on the other side. So at least one interest rate hike in the coming RBI policy this week seems to be on the cards, and a lot after that will depend on how actually inflation plans out, which would depend on how the dollar does. And one of the components, one of the key driving factors there, which is oil, actually broke down this week. So if you've seen my post, it's already online yesterday. Oil broke the rising trend line that it had from around $48 that was supporting this entire rise, and we also closed down for the month. So the chances are now pretty much high that a 5-wave rise from the $48 mark is complete, which means the trend has reversed. And the bigger risk is that the larger trend from which had occurred since below the $30 mark is an ABC complete, which means you've completed 3 waves. You can argue for 4ths and 5ths, but the third wave is actually much shorter than the first and looks on slower momentum, and therefore gives you a sense that maybe this is just a 3-wave advance, and the larger trend for oil actually turns down. And oil is a major leading indicator for inflationary expectations and the commodity markets themselves. And if it starts to drop off from here, at least a minimum drop to $58 is visible. If it holds 58, you can still make later arguments that the trend up will continue or resume from there. But if it breaks that, then you'd have to start thinking about sub $30 once again, and that would drive down probably, and that would be an indication for most commodity prices. So if that's what is happening, then the inflationary price trend that we've seen for so long could actually be in the early stages of changing. So that's I think a big change in terms of what even I was expecting, because by now you should have seen much higher inflation numbers, but you've really seen decent numbers. And could this mean that future interest rate hikes are actually going away? And could you actually see a slowdown occurring? So there are multiple things to think about, too many moving parts. But one thing that is happening is that we've started to clearly see this weakness in the broad market in India, in line with what is happening in the rest of the emerging markets. And another key trend, which is US interest rates that are rising and are continuing to rise and remain on a path of rising for at least several more months. And these factors, along with that we are into the election season over the next 1 year, are going to be risks for the market's upside potential. And I think the high valuations have good room to correct on the downside. Some people might feel that the correction so far is sufficient. But my sense, looking at the chart so far, is that we are probably in the early stages, because momentum has actually weakened from the daily to the weekly to even the monthly level charts. And therefore those cycles don't really turn easily. We should continue to watch out for, looking for much deeper readings than the extremes that we've seen over the last 6 to 8 months, or rather 1 year now, because starting from June, July of last year, we got the first reaction in mid-caps. After that, since September, we had some of the highest extreme readings in various sentiment data, put writing and so on, put call ratios, the volatility ratios and so on, that we've never seen. And not only not seen, but not seen it repeatedly happen again and again. So we got an extreme, we got a correction, and another extreme, and another correction. Historically, 1 or 2 such readings, one was usually enough to call, a market high. And this time around, we've got it once, twice, thrice, and surprisingly, even last month, because if you saw my last video in April, which I did for Sharekhan, I highlighted how a short squeeze based on the same data points was occurring once again. When if Jan was a major high, then you shouldn't really have seen a repeat of that pattern post a major high. But these readings themselves are so off the cards that they can only be reflective of a long-term distribution setup, and which is why I think that the ending diagonal that I've made for the last 5 years, which is I thought the fifth wave started or could have ended in 2010-11, but that's extended into a long-term ending diagonal ABCDE, which is the fifth wave 2010 to 2018 itself would be the entire fifth wave ending, and that completing is why you have these extreme readings popping up again and again, because this is a multi-year distribution setup, which is why so many stocks have done so badly. A few stocks are just keeping the main index like Nifty up, but the rest of the market is almost collapsed. In fact, if you would say that growth is picking up and the infra is going to do well, then cement sector, the cement stocks which were trying to hold up, and I was posting an ending diagonal pattern for the last 4 to 5 years, finally played out, because that ending pattern not only completed, but the lower line broke, both in case of ACC and Gujarat Ambuja key cement stocks. Both of them broke that and started to collapse from there. So no reflection of the underlying infra related growth on the cement sector, despite a lot of talk and hype around it's doing well. And if that's the case, then we really need more evidence to point at an upward trend in the market and the economy going forward from here. So that's what we are facing, I think, over the next 6 to 12 months as we head into the election season. Various risks that we will deal with, whether it will be spikes in inflation, whether it will be spikes in interest rates, or it will be populist measures and spending from the government that is going to go on relentlessly. They've actually pushed their entire borrowing program to the second half of this year, which will continue to put pressure on the bond market in India, and therefore I don't think we're looking at interest rates falling anytime soon, and usually it's the end of the interest rate spike that should mark the end of the winter cycle. And so I'll continue to map that trend on an ongoing basis through all my posts. So that's it. This is a long talk. I've tried to discuss all the key issues and points that I've been posting on and trying to draw and pull these strings together, and I'll continue to do that. So feel free to share this video and post all your questions on the discuss posts that I have, rather the discuss section that I have under each of my posts on the website, because a lot of people ask me about learning, and the best way to learn is to actually be in the market and to practice the markets on a day-to-day basis after you have read and learnt or studied classes, because classes are a good way to quickly learn up stuff, but market is something you don't learn by really practicing real time. And you might have questions, and post your questions, and I answer most of them on the discuss boards. So under any post you have any question on any of these issues, on whatever I'm writing about, because I write a lot on these macro charts, whether it is bond market charts or whether it's currency charts and how they link up to what is happening in equities. So post them there and I'll answer them online. So that's all from me. Thank you.